Welcome back. Kevin McPartland on the line with us, Principal of Market Structure and Technology at Greenwich Associates. He leads the firm's market structure and technology practice and has nearly 15 years of capital markets industry experience with expertise in derivatives and financial services technology. Kevin, how you doing this morning?
I'm doing well. How are you?
We're good. Just a few minutes here before the open, and well, we were talking on the line that you were interested in talking about the volatility caused by the World Cup being over. So, are people done watching the World Cup and they're going back to trading, or what's your take on this?
Yeah, it's funny. In some ways, it's a bit tongue in cheek, right? But on the other hand, there's some realness to it. If you think about, right, the markets tend to slow down in the summer, particularly in August. It seems that there might have been some effect of the traders, especially in Europe, right, being distracted and having the TVs tuned to the World Cup instead of to CNBC. So it's over. Will it get everybody back to trading? Who knows? I suspect that what Janet Yellen says will have a bigger impact than the World Cup. But time will tell. We'll take any hope of the market starting to get moving again that we can find, right?
Right, and well, we do get some. We've had some recent flurry of activity. Of course, Janet Yellen's testimony yesterday shook up the markets, and she'll be back at it today. Um, there was something out yesterday from Carl Levin, and he
Yeah.
wrote a letter to the SEC calling for an end to conflicts of interest in maker takement and payment for order flow, and whoa, Carl Levin there, making a big call. What's your take on that?
Yeah, whenever I hear anybody in Washington call for banning something, I get immediately skeptical, right? That seems to be the gut reaction. We don't like credit default swaps. We don't understand them. Let's ban them. We don't like high frequency trading. We don't understand it. Let's ban it. I think that's too much of a knee jerk reaction, and to me, it makes it feel like they don't completely understand the issues. I think, is there some truth to incentives being a bit misaligned? I think there is. But I'm a big proponent of creating incentive systems that encourage the behavior that we want to see rather than telling people what they can and can't do, right? This is a democracy. This is a free market economy. The exchanges should be allowed to sort of come to the market with business models that they think will benefit and bring them clients. I think the arrival of IEX is a great example of they think the market should work differently. If order flow goes there, then that'll be proof that they were right. But just simply banning things that they don't that people don't understand or don't like, I just don't think that's the answer.
All right. So when you see something out of Washington, you're automatically skeptical. I mean, we got to. I mean, you mentioned the IEX, and I don't think we've had you on since Michael Lewis made his big statement that the market is rigged. Boy, what's your take on that statement? Pretty broad
Yeah,
statement.
yeah, come on. I mean, the market's not rigged. The thing that the thing that I'll go with is it's way too complicated. And the reason why it's too complicated goes back to what I just said, right, about the gut reaction of regulators and the legislators to ban things and just put more regulations on top of more regulations, right? That's what's gotten us to this complicated state. If we ban maker taker, if we ban payment for order flow, those businesses are going to have to find other ways to make money, right? We need them. We need liquidity providers. We need brokers. They help the market to function. If we put a situation in place where they can't make money anymore, where are they going to go, right? We need them. We need them here. So yeah, the markets are too complicated. There's no question. I don't think adding more regulations that make them more complicated is the answer. But time will tell. I feel like we've, in the derivatives market, for example, there's been a lot of new regulation there. I think we needed some of it. We certainly didn't need all of it. And that's caused quite a lot of complexity for market participants. So, we'll see over the long run what happens. But if I had my way, we scrap it all. We take 2 weeks off. We get in a room and we stay there until we come up with a new way to get started again. But unfortunately, I don't think that's in the cards.
So is getting rid of the maker taker really going to simplify things?
No, that's like I said. I think it's just going to cause the exchanges and the brokers to look for other ways to monetize. I think the reason, and that was really one of the things that really sort of, I was doing okay as I read through Flash Boys, and one thing that really turned me off was when Michael Lewis claimed that Maker Taker was designed to help the broker screw their customers. That can't be anything further from the truth, right? I mean, my read of history is that Maker Taker was there to help startup exchanges and ECNs to attract order flow, right? It helped to create competition in the market, which is a good thing. Has it evolved to be more than that? Possibly, but again, you want innovation, you want to encourage new entrants in the marketplace to challenge the status quo, and this is one tool they've used over the years to incent people to trade on their platforms.
Okay, what about the study from the Notre Dame professor Robert Bartolo? As far as regarding rebates and rebates, essentially affecting how brokers route their orders. That's not getting the best execution if you're sending your orders where you get paid the most money for your order flow. Your thoughts on
Yeah,
that?
yeah. I mean, this goes back to the maker taker debate, right? Are the are really, I think what the argument is that they're looking for ways to send orders so they are quote unquote makers, right? So they're getting a rebate no matter what. Whereas in theory, if you're a client order, right, you're taking liquidity out of the market almost by definition. So broker algorithms in some cases are designed to look for ways that they can trade those orders as a provider of liquidity so that they can sort of gain a rebate as opposed to paying a fee. Now, in on one hand, you could look at that as well. They're looking to save customers from paying that extra fee and getting that order done more cheaply. Part to me, what this comes back to is a sort of a TCA, right, a total cost analysis of those trades. You could pay a slightly higher price on the stock if the fees are lower than your actual price could be better than if you had paid a lower price on the stock, right? So this argument's come up quite a bit in the past, but it's the difference between trading for best price and trading for best execution. And this, the more informed investors can be about what their total cost of trading was, and thinking about it from a best execution standpoint instead of a best price standpoint, I think that could go a long way. And that's what going back to the original question about banning some of these practices. The more informed the investors are about what their brokers are doing with their orders, then sort of like the free market system should work itself out naturally, right? Customers will pick up and send their commission dollars elsewhere if they don't like the way that brokers are handling their order flow.
Yeah, and coming back to the payment for order flow, isn't there an issue that too much of the order flow is never getting to the exchanges? It's all getting off exchange. And then, if that's happening, then, it's really not encouraging displayed liquidity.
Yeah, well, right. I mean, and this is where they're trying to go with the trade at rule, right? I think in some ways, in an ideal world, you have one central place where everybody can trade, and then we can see, and then we have perfect price discovery. That's certainly not going to happen. And if that happens, you end up with some of the monopoly effect where maybe you discourage competition and innovation. And of course, that's never going to happen. We're not going to go from 50 venues to one. I mean, look, we talk about dark pools a lot, right? And I think it's important to differentiate between, sort of simply, sort of creating that dark pool and creating and running a block crossing network. And I agree with many others in the market that said we want more block trading. We want platforms that allow institutional investors who, quite frankly, are investing the money of retail customers to allow them to do big blocks when they need to. If you have 10,000 shares, it would be great if there's a way that you could trade that at a good price all at once with limited market impact, as opposed to having to slice it into many hundred share orders.
So
So
you think the trade at will help?
well, I don't know if it will help. I mean, I think that the goal there is to try to move more orders onto the public exchanges. But like I said, I think what we need is a healthy balance, and it's very very hard for us to get there. I wonder if the accusations against Barclays will encourage more transparency into how these internal pools work, what their matching logic is. I would certainly encourage anyone, all of the ATSs to be more transparent over time and make their rule books public as some of the others have already done, and let and let the customers sort of understand and decide for themselves.
Have you been following the volume in the IEX? Has it been gaining some traction?
Yeah, I mean, it's doing okay considering. I mean, it's not over the top. It's not taking over the world, but they're doing relatively well. It's very hard to gain liquidity in any market as a new venue, and I'm sure anybody out there that's started an ECN, an ATS, or an exchange can attest to that. Their order sizes seem to be a little bit bigger than some of the others, so we'll see. But it's I think it's a little like these things, it's too early to tell. It takes years for these stories to play out.
Right, and then also you have the pilot program coming up. Do you think we're going to be able to gather any good information from that?
Yeah, I mean, we'll certainly gather information from it. I'm torn as to what I think the results will be, whether it will be good or bad. I think I could argue both sides of that story. It certainly will be interesting. The question is sort of what in the end the regulators do with the results of that study. If they expand it, how far do they expand it? Do they look to sort of bigger cap names and such? So it'll be interesting to see where that comes out, and I look forward to those results.
Okay, and just to close up the interview here, I mean, obviously you're dealing with larger clients and whatnot, but for the individual trader, I mean, they don't see a lot that goes behind the scenes besides questioning your broker about where your orders are routed to and whatnot. What advice do you have for our traders?
Yeah, I mean, you want to understand what your costs are, where your commission dollar is going to. And I'm also sort of becoming an increasingly large proponent that there's still a relationship game here, right? There's reasons why you might want to pick up the phone and talk to a broker and pay a higher commission than executing that order online, right? There's a lot of value that they can provide, when they're in closer to the market. And what we're seeing on the institutional side is that, the big sort of institutional investors are willing to pay higher commission rates when they feel like they're getting, good research, good information, good market color, and that it ultimately does pay off in their returns. So I think, it's important to have that good relationship with your brokers and hold them to it, and hopefully, again, even if you're paying a little bit higher to pick up the phone, that it'll ultimately pay off in your returns.
Going back to the old Smith Barney adage, we make money the hard way, we earn it. And that's an interesting take upon the online trading versus, getting information from your broker about your order flow and also about the markets. Well, Kevin, thanks for coming on again. Kevin McPartland, Principal of Market Structure and Technology at Greenwich Associates, giving us his take on market structure. Very interesting. We'll definitely have you on again. There's a lot of there's always interesting things going on with market structure. So we appreciate your opinion, and we'd like to have you on again, as I said.
Always love being on, talking to you guys. Great conversations. And like you
Okay.
said, always something in market structure.
There always is. Okay, Kevin, thank you very much.